Late at night, a kitchen light still on. You open your banking app. A small line of text hits you like a punch. This month's payment, higher. No one knocked on your door to announce that rates went up. No sirens. No chaos. No headlines tailored to your life. Just a silent shock. And here's the uncomfortable part. It doesn't hit everyone equally. It picks winners. It picks losers. And it sends the bill to people who never voted for it. Because when interest rates jump, the question isn't, is inflation falling? The real question is, who actually pays the bill? Today we're going to follow that bill through the system, through households, small businesses, banks, governments, and the safe assets everyone claims to love. We'll keep the language simple, but we won't make the story simple because the system isn't. And by the end, you'll see why a rate hike can feel like a tax, even when no one calls it that. So let's start with the moment the shock becomes real. You don't feel a central bank decision. You feel your EMI, your rent, your job security. You feel your savings earning nothing, or your investments suddenly getting punished. That's the silent rate shock. And it's not a story about numbers. It's a story about power, who has it, and who absorbs the cost when the economy has to be slowed down. Imagine the economy as a speeding car. Inflation is the engine running too hot. Rate hikes are the brakes. But here's the trick. When you slam the brakes, the passengers don't all move the same way. Some people have seat belts. Some don't. Some are sitting comfortably. Some are standing in the aisle. The same brake can be a mild slowdown for one person and a violent jolt for another. Now, before we go deeper, let's kill the hype version of this story. The hype version says, higher rates are good. They reward savers. They punish reckless borrowing. They fight inflation. The economy becomes healthy again. That's neat. It's also incomplete. Because higher rates don't just reward savers. They reward certain savers. They don't just punish borrowers. They punish the weakest borrowers first. And they don't fight inflation by magic. They fight inflation by doing one thing and one thing only. They reduce spending by making money more expensive. Which means someone has to stop spending. Someone has to postpone. Someone has to downshift. Someone has to break. That someone is the bill. Let's follow it. Start with households. If you have a floating rate loan, you're the first to feel it. Mortgage, business loan, personal loan, credit card interest, anything tied to short-term rates. Your monthly payment goes up immediately. Not in theory, not over time, in your life. And because household budgets are not infinite, that extra payment has to come from somewhere. You cut discretionary spending. You delay big purchases. You reduce travel. You reduce upgrades. You reduce nice-to-haves. And when millions of people do that at once, it doesn't just hurt them. It hurts the businesses they used to pay. That's where the story moves next. Small businesses. A small business doesn't have a treasury department. It doesn't hedge interest rates. It can't issue bonds globally. It has cash flow, inventory, and maybe a working capital loan. When rates rise, financing costs rise. And if demand falls at the same time, because households are cutting spending, then the business gets squeezed from both sides. Higher costs, lower revenue. So what does it do? It raises prices if it can. But if customers are already cutting spending, it can't raise prices much. So it cuts elsewhere. Marketing, hiring, expansion, sometimes wages, sometimes headcount. And now we're at the part central bankers rarely say out loud. But everyone in markets understands. Rate hikes work partly by weakening the labor market. Not because they hate workers. Because a cooling economy is the mechanism. Less spending means less growth. Less growth means fewer jobs. Fewer jobs means wage pressure falls. And when wage pressure falls, inflation slows. That's the system. It's not clean. It's not moral. It's a lever. But here's a twist most people miss. Even if you don't have a loan, you still pay. Because rate hikes change the entire price of money. And money is everywhere. Let's talk rent. Rents don't move because interest rates move. They move because housing supply, demand, and investor economics move. When rates rise, new construction becomes more expensive. Developers slow down. Projects get delayed. That means fewer new homes in the future. Supply tightens. At the same time, higher mortgage rates push people out of buying. More people stay in the rental market. Demand rises. Supply slows. That's rent pressure. So even if you're not a borrower, your housing cost can still rise. And if you're thinking, okay, so borrowers and renters pay. Savers win, right? Sometimes. But not always. Because the inflation story is not just about today. It's also about what happened before. If you spent years in a laureate world, you probably built a life around cheap money. Cheap EMIs. Cheap expansion. Cheap valuations for assets. Rate hikes don't just increase payments. They reprice everything built on the assumption that money would stay cheap. Let's talk about assets. When rates rise, the discount rate rises. That's a finance term, but the idea is simple. If money today is expensive, then future money is worth less. So anything that depends on far-off future earnings, growth stocks, startups, long-duration assets, gets hit hard. That's why you see tech and high-growth sectors crash first in a rate shock. Not because the companies instantly became worse, but because the math changed. The same expected profits now have a lower present value. So who pays here? Investors. But again, this isn't equal. If you're a wealthy investor with diversified assets, you can absorb a drawdown. If you're a retail investor who entered the market during the boom, thinking this is how money is made, the shock feels personal. And there's a deeper layer: pensions, insurance companies, and institutional portfolios. They don't just lose money. They change behavior. They shift allocation. They tighten risk. That matters because it shapes what gets funded in the economy. If capital becomes more expensive, fewer projects get approved. That's slower innovation, slower growth, fewer jobs. Again, the bill. Now, let's move to the part most people assume is protected: banks. Because in the hype story, higher rates are good for banks. They can charge more for loans. That's true, sometimes. But in a sharp rate shock, banks can face a different problem: mismatch. Banks borrow short and lend long. They take deposits, and they buy longer-term assets or give longer-term loans. If rates rise quickly, the market value of long-term bonds falls. If the bank is sitting on a lot of those bonds, it has unrealized losses. If depositors stay calm, it can hold the bonds to maturity and recover. But if depositors panic and withdraw, the bank may be forced to sell at a loss. That's when a rate hike can quietly turn into a financial stability issue. So even banks can pay the bill. And now, we have to go to the biggest player in this whole story: the government. This is where the conversation becomes politically sensitive, because everyone has an opinion on public debt. But let's keep it simple. Governments borrow, rates rise, new borrowing becomes more expensive, refinancing old debt becomes more expensive. That means debt servicing costs increase. So who pays? In theory, taxpayers. In practice, it depends on how the government responds. It can raise taxes. It can cut spending. It can increase borrowing even more. Or it can rely on inflation to reduce the real burden over time. Each option shifts the bill to different groups. Cut spending. Who pays? People who depend on public services. Raise taxes. Who pays? Depends on who gets taxed. Borrow more. Who pays? Future taxpayers. And potentially inflation later. Let inflation run. Who pays? Anyone holding currency and fixed income assets. And here's the uncomfortable truth. When rates rise and debt is high, governments face a choice between pain now and risk later. Pain now can mean austerity-like pressures. Risk later can mean financial repression, keeping rates below inflation, encouraging savings to flow into government debt, and slowly eroding real wealth. This is why the "who pays the bill" question becomes a question of power, not economics. Because the bill can be pushed around to households, to renters, to workers through jobs, to small businesses through cash flow, to investors through asset repricing, to taxpayers through budgets, to savers through inflation. And sometimes, the bill doesn't get paid. It gets rolled over. Now let's zoom out and connect the pieces. A rate shock is not a single event. It's a chain reaction. Higher rates reduce spending. Reduced spending slows businesses. Slower businesses slow hiring. Weaker hiring slows wage growth. Slower wage growth slows demand. Demand falling slows inflation. That's the intended path. But there's always a second path, unintended. Higher rates increase debt service. Higher debt service pressures budgets. Budget pressure triggers cuts or taxes. Cuts or taxes reduce demand further. And at the same time, asset prices fall. That weakens confidence. Weaker confidence reduces spending again. Now you've got an economy not just cooling, but tightening into itself. This is why rate hikes are blunt. They don't aim at greedy companies. They don't aim at supply shocks. They aim at demand, which means they aim at people's ability to spend. And here's where the silent part becomes dangerous. Because when pain is distributed, it's hard to see the full picture. One person sees EMIs rising. Another sees layoffs. Another sees their portfolio down 30%. Another sees the government cutting programs. Another sees rents rising. No one sees the whole bill. So they blame different things. They get pulled into different narratives. And that fragmentation is not just a social issue. It's a policy issue. Because the more fractured the story becomes, the easier it is to pretend the system is working as designed when it may be breaking in specific places. Now let's address the question people always ask at this point. So what's the alternative? Just don't raise rates. No, but we need to be honest about what rate hikes are. They are a tool that fights inflation by reducing demand. And reducing demand means reducing someone's spending power. So the bill is not optional. The real question is, how fairly do we distribute it? And do we even admit that's what we're doing? Because in public, we talk about containing inflation expectations. We talk about anchoring. We talk about normalization. Those are clean words. But in real life, the mechanism is messy. It's job offers disappearing. It's small businesses delaying expansion. It's households cutting consumption. It's financial markets repricing risk violently. And if you're in a country where household balance sheets are fragile, or where informal employment is large, or where credit growth had been the engine of prosperity, a rate shock can feel less like a policy adjustment and more like a slow-motion squeeze. Now, let's make it even more uncomfortable with one final layer. When rates rise, the people who can buy assets with cash often get opportunities. If you have cash, higher rates can mean better yields, better deals, cheaper valuations. If you don't have cash, higher rates mean higher costs and more fragility. So the same shock that hurts many can set up the few to gain later. That's how inequality can widen after a tightening cycle. Not because someone plotted it in a room, but because the system rewards resilience. And resilience is often just another word for wealth. Now we're at the ending. Not a neat conclusion. A question that should bother you. When a central bank raises rates, they call it fighting inflation. Markets call it tightening. Economists call it cooling demand. But to the person who loses a job, or the small business that collapses, or the household that watches its payment creep up month after month. It looks like something else. It looks like a bill being paid, quietly, by people who didn't run the engine hot in the first place. So here's the question that matters. If the only way to fix inflation is to slow the economy enough that someone breaks, then who gets to decide who that someone is? And more importantly, what happens to a society when the biggest financial decisions are felt as silent shocks instead of understood as deliberate trade-offs? Because the next time rates move, you won't hear the decision. You'll feel it. In a small line of text, in a monthly payment, in a rent increase, or in a job market that suddenly looks colder than it did last week. The shock will be silent. But the bill will be very real.